Hi everyone, this is this video for HSA scenario number 5, Peggy Walker. And in this scenario, we're actually going to have to use TaxSlayer. They want us to fill it out from TaxSlayer and fill out the following forms, everything, so we can do that from TaxSlayer. Okay, so let's read through the interview notes really quickly and then see what we have. Alright, so interview notes. Peggy Walker, age 48, is a single parent raising her son Marcus. Marcus is a full-time student and had no income. Peggy qualifies to file as head of household. For the last 5 years, Peggy has had family health coverage through a high-deductible health plan, HDHP, from her employer. Peggy has had an HSA for several years. In 2017, she contributed $1,500 to her HSA. Peggy's grandmother helped her out and contributed $1,000 to her HSA in 2017. Peggy's employer also contributed $600 to her HSA in 2017. Peggy paid the following expenses in 2017 using money from her HSA. Urgent care bill for Peggy, $615, prescription medicine for Peggy, $200, insulin for Marcus, $140, health club fees for Peggy, $175, doctor visits for Marcus, $500. And then Peggy and Marcus are U.S. citizens and have valid social security numbers, as we can see right here. Great, so let's move on to the intake and interview and quality review sheet. Let's see if there's anything on here that seems a little bit weird or questions that we might need to ask them. So we have this. Here it says never married, but in the interview notes it says that she qualifies as head of household, so that was really nice that they just gave that to us. Marcus Walker, now he's 20, which usually means that he might not be a dependent, but we also know from the dependency tree that if they're under 24 and a full-time student, then they can count. And since Marcus is a full-time student, even though he's 20, he can still be a dependent on Peggy because he has no income. We can go through the dependency decision tree in a little bit. All right, continuing going. Yes, no. So she had a W-2. Great. She just had one. I think we'll see that from her. Yep, it's right there. That's a W-2. Here she marked unsure. So it says other income, gambling, lottery, prizes, awards, jury duty, etc. And then she says HSA distribution. So she's unsure if she has other income. So since we have to go through and do the HSA distribution because she marked here medical expenses and HSA, we'll kind of come back to that and see if any of her HSA distribution counts as other income or not. So for right now, I'm going to kind of smooth over that, but at least we know that she's unsure, and by the time we finish the return, we'd want to mark it either yes or no before we turn in this intake and interview form. All right, it says she did have health coverage and none of these things. So that looks great. She does want to just contribute $3 to her plan, and nothing else here. Cool. So let's move on and actually start her return on TaxSlayer. So I'm just going to click on Start New 2017 Tax Return. Start Return. Social Security number, I have to get that from here, 44100. I'm just going to use 4 ones as her XXX. Alright, so in the interview notes it said that she qualifies as head of household, so we can just click on that right away. And I'm just going to start filling this all out from that intake form here. I'm going to look at my hard copy so I don't have to go back and forth all the time, but we will just start with Peggy Walker. Social Security number, that's correct. Her birthday is May 20th, 1969. Occupation, manager. Alright, can she be claimed as a dependent on someone else's return? No, she can't. If they were over 18 and full-time student, no, she's not. Check here if the taxpayer is blind. On there it says she's not legally blind. She's not deceased. She does want to contribute $3. We found that out from her intake and interview form. Check here if the taxpayer or spouse was in combat zone. We don't know anything about that. I would say no. And she's not a non-resident alien. Alright, her address. 65421 Southwest 17th Street. No apartment. I'm just going to put Provo. And her phone number is really exciting. Right there. Okay. Dependents or qualifying persons. So, yes, we believe that we have a dependent for our return. Let's make sure that Marcus does qualify as a dependent, though. So here we come to the publication 4012, and we can come to the dependency. So let's go to overview of the rules. So to be a qualifying child, the child must be your son, daughter, stepchild, foster child. Well, Marcus is her son, so that's great. The child must be under age 19 at the end of the year. He was 20, and younger than you, he was. Or be under the age 24 at the end of the year, a full-time student. So we know that he was 20, but that he's a full-time student, so he counts this. And then the child must have lived with you for more than half of the year. Well, he was at school. It doesn't really say that, but it does say that there are exceptions for temporary absences. And one of those absences is for school. I don't actually know if it says that right here, but that's actually true. So if they were at school, then it counts as them living with them for more than half the year. The child must not provide for more than half of his or her own support. Since he had zero income, that would be true. The child isn't filing a joint return for the year. He's not married, so that's not possible. And if the child meets the rules to be a qualifying child of more than one person, he doesn't. So he is her qualifying child, and he can be her dependent. So, yes, Marcus is a dependent of Peggy. So let's stick in Marcus. His birthday is that. Social Security number. Whoa. Yeah, I know. Sorry about that. Alright, he is her son. And he lived with her for 12 months of the year. And let's see, check if this person was over age 18 and a full-time student. Yes, that is true for him. Check if this person was disabled. No. Check if this person, the qualifying child, is not your dependent. That's not true. He is her dependent. Check if you wish not to claim this dependent for earned income credit purposes. He would be considered that, so he's fine. And check if this dependent is married. He's not. So, let's continue. And that's our only dependent, so we'll move forward. Okay, so let's look at the money we've earned. On our interview form, the only income section is just a W-2, possibly that other income, but we'll come back to that. So we have a W-2, so I'm just going to click on Enter myself, or even you could do W-2. Go to Form W-2 now. That would work too. So let's just do that. W-2. All right. So from the scenario stuff, we know that this is Peggy's W-2, which makes sense because Marcus didn't even have any income. We'd find the employer identification number right, let's see, here in box B, 44100. Okay. The employer name, Williams Manufacturing, yep, that matches, so let's continue on. Box 1, wages, that is just found in box 1. So whenever you do a W-2, it's really simple. It just will say box 1, and you just look at this box number here and just fill it in right there as it says. So box 1, we have 34,620. Box 2, 2369. And these will fill out and automatically populate. Just make sure that they do match, because sometimes they won't match, so make sure that they do, and if they don't, you can change them. But in Peggy's case, they do match up, so we can just leave them. And box 7, 8, 9, 10, 11, they are all blank, but box 12 we have a code W. And that has $600 on it. Okay, all of the rest are blank except for the state information, so we'll hurry and put that in. Let's see. Okay, her state wages were $34,620, great, and her state tax paid was $456. Okay, so that looks good to me, so let's continue. And press continue. Okay, we don't have any other income from her interview notes in her intake form, so we can move on to her expenses and adjustments and everything. So it says that she has medical expenses. Let's see, let's come up here. Yeah, so she has medical expenses and she has an HSA. And I'm assuming that those medical expenses are from her HSA. You would ask her and say like, hey, is that what you're talking about? And she'd say yes. So let's type in, so let's figure out where we would do the HSA. Probably under, actually, okay, so in HSA you fill out form 8889. So I'm just going to click on that because it's easier. You can probably figure it out from this as well. But this is what you'd fill out for a health savings account. So let's start it. Okay, so was she coverage under high deductible health plan? We can either do self-only or family. So let's go back to her interview notes. Whoops, too far. Okay, so it says Peggy has had health family coverage through an HDHP. So we will select family. Check here if you and your spouse have separate HSAs. That's not true. She doesn't have a spouse. HSA contributions. HSA contributions you made for 2017. Include contributions made from January 1st to April 15th of this year that were for 2017. I don't think we have anything there. Do not include employer contributions through cafeteria plan amounts that were rolled over into your HSAs. So what exactly goes into this box? Let's go to our publication 4012, that Bible, and see how to fill out this form. So the HSA is an adjustment to your income, and we are going to look at this box and fill it out. Okay, so this looks like the form that we are filling out right now. So let's look into it and see what this box says. So we have a little explanation here. It says employee contributions, yes, so Peggy's the employee. Contributions are entered here. Contributions by relatives and friends are considered to be made by taxpayer. Do not include employer contributions on this line, etc. So they might give us a form 5498, but they might not. And here it says the taxpayer spouse may receive Form 5498 SA for the HSA contributions. If the taxpayers don't have this form, they can provide the information regarding HSA contributions based on their records. So we might have a form with that, but we might not. We just have to trust them if they don't give us a form for what their amounts, their contributions were. Okay, but like we said, so employee contributions and contributions from relatives and friends. So coming back to our interview notes, it says Peggy contributed $1,500 to her HSA. Peggy's grandmother helped her out and contributed $1,000. So the total contributions that would go in that line are $2,500, because that's the $1,500 from Peggy and the $1,000 from her grandmother. Okay, number of months during this tax year that you were an eligible individual. She would be 12. It doesn't say anything about her not being eligible, and she's had this HSA for several years, so you know that she's had one. But you can also figure out if she was eligible by going to this publication 969. And just towards the very top, it says qualifying for an HSA. To be an eligible individual and qualify for an HSA, you must meet the following requirements. You are covered under an HDHP, and that's true. It says that you have no other health coverage except what is permitted under other health coverage. And she doesn't say anything about having other health coverage, so I'd assume that you are not enrolled in Medicare. She didn't say that she was. and you can't be claimed as a dependent on someone else's 2017 tax return, and she can't. So she would be a qualifying individual for the health savings account. Okay. Amount you and your employer contributed to your Archer MSAs for 2017. We don't have any information on that, so I'm just going to leave that blank. Employer contributions made to your HSA for 2017. Great. Well, here it said that Peggy's employer also contributed $600 to her HSA in 2017. It says, we will automatically pull your employer contributions from your W-2. Do not enter amounts from your W-2. Okay, well, what is employer contributions from the W-2? If we come back to the publication 4012, it says taxpayers form W-2 has box 12 entry code of W for their employer contributions. So let's come back to her W-2 and see if that's what she had. Let's see, so box 12W, and it was $600. So that means that her employer contributed $600 from her W-2. So since it's already on her W-2, then we're not going to fill that out. So we're just going to leave that blank because it will automatically be pulled. Okay, qualified HSA funding distributions from IRA or Roth IRA. We don't have any of that information, so we are going to leave that blank. Okay, HSA distributions. Total distributions received during 2017 from all HSAs, usually shown in box 1 of forms 1099-SA. So let's come back to our scenario. She does have a 1099-SA, which are her distributions, and box 1 it says $1,630, and it has HSA marked. So we know that this came from her HSA. These are her gross distributions, and if you wanted to add it up, then you can see that all of these amounts add up to $1,630, which is what she has as her total distributions. So we're just going to put that in there as $1,630. Distributions used for qualified medical expenses. Okay, if you do not enter an amount here, your entire distribution will be considered taxable. Well, that sounds not very fun. So let's see what her qualified medical expenses are. And I'm going to come to publication 969 because we can look here for what qualified medical expenses are. So we have qualified medical expenses right here under the distributions. So it says qualified medical expenses are those specified in the plan that generally would qualify for the medical and dental expenses deduction. They are explained in publication 502. We don't really have publication 502, but we can also find it in publication 4012, which we'll go to. Non-prescription medicines other than insulin are not considered, and then it says medicine or drug will be qualified medical expense for HSA purposes only if the medicine or drug, 1, requires a prescription, 2, is available without a prescription, an over-the-counter medicine or drug, and you get a prescription for it or is insulin. Okay. So, this is technically for HRA, but it's the exact same thing. Okay, so let's come back to what her expenses were and look if these all qualify or not. So, urgent care bill for Peggy, $615. Well, I'm not positive, but let's go see if that would count as a normal medical expense on your itemized deductions. So to find the itemized deductions, I'm going to go to tab F, deductions, and then down here we have itemized deductions. And if you come down to Schedule A, itemized deductions, here we have deductible and non-deductible medical expenses. So you can scan through this, and we are looking for her urgent care bills. Well, I've already looked through this. There isn't anything about urgent care specifically, but it does say medical services fees from doctors, dentists, surgeons, specialists, and other medical practitioners. So that would count as an urgent care bill. And also there are hospital service fees, so you can imagine that her urgent care bill would be considered either medical service fees or hospital fee and everything. So her medical service or her urgent care bill would count. Prescription medicine for Peggy. Well, from the publication 969, we learned that prescription requires a prescription, so things with a prescription do count. So the 200 counts. Insulin for Marcus, that does count. It says is insulin, that will count as a qualified medical expense. Health club fees for Peggy. Well, I'm not sure about that. That sounds like it could just be a medical expense, but let's go see. So if you scan through these and you say if you can include, but also you can't include. And over on this you can't include, it says expenses for your general health, even if following your doctor's advice, such as health club dues, household help, social activities, trip for general health improvement. So she had health club dues, and that's under the you can't include. So that would not be considered a qualified medical expense for Peggy. And then doctor visits for Marcus, that would follow under the same medical services fees here. So those would count for it. Okay, so that's all that we have. So we've looked at that, and we just know that the only ones that don't count are these health club fees for Peggy. So let's come back to our TaxSlayer Pro. And since let's come here. So distributions used for qualified medical expenses. Let's add all these up except for the health club fees. So we have 615 plus 200 plus 140 plus 500. 1455. Great. So those were her qualified expenses. Okay, distributions you received in 2017 that you rolled over into another HSA. It has no information on that, so we're going to leave it blank. Okay, check here if you meet any of the exceptions to the 20% tax. And up here it says exceptions. The additional 20% tax does not apply to distributions made after the account beneficiary dies. Well, that hasn't happened because Peggy's still alive. Becomes disabled, and on her intake form, it specifically says that she is not disabled. Or turns 65, and she is not 65 yet. She's only a certain age, but she's not 65. She's 48. There we go. Okay, so she doesn't meet any of those exceptions, so we leave that box unchecked. And here we don't have any adjustments. So like this one, this amount will adjust a calculated amount, so TaxSlayer Pro is just going to do it. All of these will actually just it'll just calculate it itself. So we can hit continue and move on. Okay, so those are all the forms that we have, and if we come back to her intake form, that's all that she really gave us. We did her W-2, we did her medical expenses through her health savings account, and then let's see if any of her health savings account was considered other income. Oh, and then health coverage, and that's because she had it through her health savings account. Technically, we should go through and do that for her health insurance and just show that she did have health care. So she was covered. You would just ask her more information about it. Her intake form says that it was not purchased through the marketplace. But yeah, as you do it, just ask her what her health insurance was. Did she have it all year? And you can just trust what they say. They don't have to have any proof of their insurance for you. So let's continue to the summary. And let's look at our questions because we're done filling everything out from what we have. So let's see what the questions are. So the amount of Peggy Walker's health savings account deduction reported on Form 1040, line 25 is $1,500. Well, let's go to 1040, line 25. Here we have health savings account deduction is $2,500. So that is false. So for question number 12, the answer is false because it was $2,500 on there. All right. 13. How much of Peggy's HSA distribution is taxable? So if we come back, well, we know that, if we already filled out her Form 8889. Let's click on that again. And the taxable amount of distributions are what is like the difference between your total distributions and the qualified medical expenses. So here we have her total distributions as $1,630 and her qualified medical expenses were $1,455. So her taxable amount was $175. And that makes sense because that was the amount that her health club dues were. And so we know that that part is taxable. So here for number 13, the answer is C, 175. All right, number 14, the amount of unreimbursed qualified medical expenses reported on Form 8889. So that is just what her qualified medical expenses were. So we're already here on our Form 8889, and we know that her qualified medical expenses were $1,455. So here we would just write $1,455. Great. And unreimbursed just means, like, let's say, she was through her insurance plan or something like that, they gave her a reimbursement. So you can't include anything that you paid if you got reimbursed for part of it. You can only do what was out of your pocket unreimbursed. So that's what that means. Okay, and question, so this answer was 1,455. All right, question 15. What is the amount of the additional 20% tax reported on Form 8889, line 17B? All right, so let's come here. And here, it doesn't really show it. I mean, there's no like line 17B on the Form 8889. If you actually look at a real Form 8889, this is from a different scenario, but you can see that you would multiply the amount that was taxable by 20%. So we can do that ourselves because we know that her taxable amount was $175. We had already done that from a previous question. But then there's also, if you come onto the summary, on line 2, there will be a tax. So the tax for that extra part is right here, that 35. So it says taxes from, there's not this specific form, but this $35 does come from her taxable amount on the 175. But we can also just do it ourselves, have 175 times the 20% tax, which is $35. So there you have that. So if we come back to the amount, what is the amount of the additional 20% tax reported on Form 8889, line 17B? And that's $35. Okay, now we're done with the questions. Yay, look at that. But I want to go back to one more thing because on her intake form, she marked unsure about the other income. And I just want to make sure that we know whether we should mark yes or no. So if we come to her 1040, on the other income line, it does show 175 HSA. So she does have other income, and that's because part of her distributions had to go towards something that wasn't a qualified expense. And so it's taxable amount that came out, so she would need to put it as other income because pretty much it's like she's getting this income from a source to pay for something that's not qualified. So it is considered other income for her, and it's listed on line 21. So even though that's not a question for us, it's good to know, and we would also need to we would need to recheck her intake form. You could just kind of scribble that out and mark yes, because she does have other income. All right, so that's it for Peggy, and that is the final scenario for the HSA test. So good luck taking the HSA exam. We hope you do great and that these things have helped. All right.